Imagine buying like a massive state-of-the-art house, right?
Okay.
And the exact day you move in, the architect, the lead builder, and the real estate agent, they're all just desperately sprinting out the back door with their final paychecks.
That's a terrifying visual.
Right. That unsettling feeling of just wondering what hidden structural flaw they know about
Yeah.
that you don't. I mean, that is exactly what looking at Celestica's stock feels like right now.
Oh, absolutely.
Because, I mean, is it even possible for a stock that's up almost 30% in 10 days to be an undervalued strong buy while it's, simultaneously flashing glaring sell signals and experiencing heavy insider dumping?
It's the ultimate market paradox because you usually want to see a unified narrative when a stock charts a vertical climb like this.
Exactly.
But right now, we are looking at a puzzle where the fundamental momentum, the technical indicators, and the executive order flow are actively fighting each other.
And that tension is exactly what we are unpacking today. So welcome into the deep dive, everyone.
Glad to be here.
Today, we're putting Celestica Inc., ticker symbol CLS, completely under the microscope.
Okay.
So as of April 10th, 2026, the stock closed just over $351.
Right, which is right on the heels of a massive 7% single-day gain.
Yeah, driven entirely by the absolute frenzy surrounding the global AI infrastructure build-out.
Which is just relentless right now.
It really is. So our mission today is to dissect the financial bedrock, the technical signals, and the incredibly heated bull versus bear debate to figure out what is actually happening behind the ticker.
Yeah, we have a tremendous amount of ground to cover. I mean, we need to look at everything from their latest income statements and short interest data down to the physical concrete they're pouring for new manufacturing facilities.
We really do. But before we jump into those blueprints, make sure to like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave your feedback in the comments. We want to know what you think of this setup.
Yes, definitely let us know.
Now, to truly understand the hype surrounding Celestica right now, we have to start with the financial realities driving the narrative.
Right. The historical price action over the last year is probably the best place to start because the market has completely repriced the reality of this company.
Oh, completely.
I mean, back in April of 2025, this stock was scraping a 52-week low of about $75.
$75. And then by November 2025, it had rocketed to a high of $363.40.
It's wild.
And today, we're hovering right near those historic highs.
Yeah.
But when you look at the trailing 12 months and the annual numbers for fiscal year 2025, you start to see the engine behind that repricing.
Yeah. Total revenue hit $12.39 billion,
Wow.
which is a 28% jump year over year, which in the world of physical hardware and supply chain logistics, that is a staggering pace of growth.
It's massive.
Yeah.
And they pulled in a net income of about $832.5 million.
Right.
So that gives us a diluted earnings per share of $7.16 on a GAAP basis. And management, I mean, they aren't backing down at all. They just aggressively raised their 2026 revenue guidance to $17 billion.
$17 billion, yeah.
But, okay, let's unpack this. Because I'm looking at these massive multi-billion-dollar revenue numbers, and then I see the profit margin.
Ah, right, the margin.
It's sitting at roughly 6.7%. And right now, this company commands a market cap of over $40 billion.
Yep. Roughly $40.4 billion.
So valuing a company with a single-digit profit margin at $40 billion feels like, well, it feels like pricing a massive high-volume shipping port as if it were a high-end luxury boutique. How does a 6.7% margin actually support that valuation?
Well, because that massive shipping port processes millions of containers a day, you have to evaluate Celestica based on the mechanics of their specific industry.
Okay, fair enough.
They're an electronics manufacturing services company, an EMS. They physically build the architecture that powers the cloud and AI.
The actual nuts and bolts.
Exactly. In hardware infrastructure, you never see the 70 or 80% profit margins that software companies enjoy because physical manufacturing is incredibly capital intensive.
Right, you're not just writing code.
No, you have to buy land, build factories, source raw materials, and manage complex global logistics.
So they are basically playing a volume game. The sheer scale of the revenue compensates for the tight margins.
Exactly. When you are processing $12.4 billion in revenue and projecting an acceleration to $17 billion, A 6.7% margin translates to a massive amount of absolute cash.
Yeah, that makes sense.
And we see that clearly in their EBITDA earnings before interest, taxes, depreciation, and amortization, which sits at a very robust $1.21 billion.
And they clearly have confidence in that cash flow, because in the fourth quarter of 2025, they executed nearly $36 million in share repurchases.
Yeah, they were buying back their own stock.
Right. And when a company does that, the corporate entity is essentially saying, we believe our shares are undervalued, so we're going to invest our cash in ourselves.
And here's the catch, if the corporate entity is buying with one hand, the executives running that entity are aggressively selling with the other.
Yeah, that divergence takes us directly behind the curtain.
The financial growth is undeniable, but the actions of the people executing that growth introduce a major red flag.
Let's look at the raw order flow, because the scale of the selling from the absolute top of the food chain is intense.
It really is.
Like President Jason Phillips sold approximately $36.49 million in stock just recently, in February 2026.
Wow.
And the CEO, Robert Mionis, has offloaded roughly $71.2 million over the last 24 months.
And if we narrow our lens to just the short-term momentum, like the last 3 months alone, insiders have executed 9 separate sell orders, liquidating over 331,000 shares.
While placing exactly 0 buy orders. 0.
0 buys.
Now, we do have data showing some contrasting order flow from outside the executive suite. And, we don't take sides politically here. We just analyze the public data. But it is fascinating that Representative Cleo Fields, a Democrat from Louisiana, purchased $65,000 in Celestica shares within the last year.
Oh, that is interesting.
Right. So you have politicians buying while executives are dumping. But sticking to management, if the CEO and president are so confident that they just raised 2026 revenue guidance to $17 billion, why are they cashing out tens of millions of dollars right now?
It's a great question.
Like, are they seeing a structural ceiling that retail investors are completely blind to?
Well, you have to separate the mechanics of executive compensation from genuine market warnings. In the corporate world, top executives receive a massive portion of their overall compensation in equity.
Right, stock options and grants.
Exactly. To avoid holding all their personal net worth in a single asset, they use pre-scheduled trading plans known as 10b5-1 plans to systematically sell shares over time. It is a very standard mechanism for diversifying personal wealth.
I mean, true. If your compensation package was tied to a stock that just went from $75 to over $350, you would absolutely take some chips off the table.
You would be reckless not to. However, the sheer volume of this liquidation paired with the absolute 0 on the buy side over the last quarter, it really tests the limits of that routine diversification argument.
Yeah, it starts to look a bit suspicious.
When the architects are selling out of the building they just designed, you have to look at how the market is handling that pressure.
Which means we need to look at the charts. Because if tens of millions of dollars in shares are being dumped onto the market, the technical analysis will show us if buyers are actually stepping up to absorb that supply, or if the structure is beginning to fracture. And right now, the trend direction is fiercely bullish. The stock is up 28.51% over just the last 10 trading days.
That is nearly vertical momentum. But vertical momentum requires structural support. Historically, the immediate buy levels, the support zones where buyers step in to halt a slide, are sitting around $335.
Okay.
Below that, you have a major historical support floor at $253, and the moving average support sits at $239.
And above us, we have the resistance levels, where the stock historically struggles to break through. There is heavy resistance near $355, and then the 52-week high of $363.40.
Right. And analysts note that if it breaks that high, the next major psychological barrier is around $365.
But to understand if Celestica has the strength to actually break that resistance, we have to evaluate the underlying technical indicators. And they are painting a highly conflicted picture.
Very conflicted. The relative strength index, the RSI, over a 14-day period is oscillating between 63.77 and roughly 68.8.
So it's technically neutral, but it is creeping dangerously close to that 70 threshold, which marks overbought territory.
Exactly. At the same time, the MACD, the moving average convergence divergence, is flashing a bullish signal. And both the 50-day and 200-day simple moving averages are incredibly bullish.
Yeah, the 50-day is sitting around $286, and the 200-day is near $262. So the current price is trading miles above both of those historical averages.
Sounds incredibly strong until you look at the stochastics indicator, which
Yep.
is currently sitting at 92.67.
Oh, man. A stochastics reading of 92 is like looking at an overpressurized industrial pipe.
That's a great way to put it.
Right. The 50-day and 200-day averages show that the volume of water flowing through the pipe is massive and moving fast, but that 92.67 reading tells you the structural integrity of the pipe itself is being tested to its absolute breaking point.
That is exactly the mechanism at play here. Stochastics measures the current price relative to its historical trading range. Anything over 80 indicates that the momentum has exhausted itself and the asset is heavily overbought.
So at nearly 93.
At nearly 93, it is flashing a glaring sell signal, suggesting a very high probability of a severe short-term pullback. The pressure inside that pipe is critical.
And if you introduce a high short interest to an overpressurized pipe, you get extreme volatility. The short interest ratio is currently at 19.15%.
That's huge.
It is. Nearly 1/5 of the available float is being shorted by traders actively betting that the pipe is going to burst and the stock will plummet.
That 19% short interest acts as an accelerant, but it can explode in two entirely different directions.
How so?
Well, if that stochastic sell signal is accurate and the stock begins to drop, the panic selling accelerates the fall, and those short sellers profit massively.
Right, a rapid unwinding.
But if the fundamental buying pressure manages to break through that $363 resistance level, you trigger a mechanical chain reaction.
The short squeeze.
Yes. All of those short sellers are forced to buy the stock at market price to cover their losing positions. That forced buying creates a short squeeze, driving the price up violently.
Which brings us to the ultimate tension of this deep dive.
Here we go.
We have a stock experiencing a 28% 10-day run, a stochastics indicator screaming that the trend is exhausted, nearly 20% short interest acting as explosive fuel, and executives quietly cashing out millions.
It's a powder keg.
It really is. So how do we actually value this company today? Is Celestica an undervalued gem executing a massive transition? Or is it a classic value trap waiting to spring on retail investors?
Well, if you ask the professional analyst community, there is surprisingly little debate. Out of 18 or 19 analysts covering the stock, the overwhelming consensus is a strong buy.
Really, a strong buy across the board.
Almost entirely. And the price targets they are issuing are aggressive.
Yeah, I saw the average targets range from about $263, which honestly feels like a stale target from before the recent run-up all the way to $381.
Right. But the high-end estimates are staggering. Bank of America has slapped a $400 target on it, and Goldman Sachs is pointing to $440.
That's $440. That's incredible. How do analysts justify those massive targets?
By looking at the forward valuation multiples, the trailing price-to-earnings ratio sits at 49.07, which sounds high.
Very high.
But when you look at the forward PE, which factors in projected earnings over the next year, it drops significantly to 39.22.
Okay, so the mechanics of their growth are moving so fast that the stock essentially gets cheaper relative to its own profits as time goes on.
Precisely. They rely on the PEG ratio, price to earnings to growth, to argue that if you factor in the sheer velocity of their near-term revenue expansion, the stock is technically undervalued right now.
Well,
And the mechanics of that bull case are heavily anchored in their hyperscaler business, which is seeing explosive 66% growth.
and just to clarify for everyone, the hyperscalers are the titans building the physical data centers where global AI lives. Places like Google, Amazon, Microsoft.
Exactly. And Celestica isn't just riding the coattails of that expansion, they are securing the foundational architecture. They recently won design awards for 1.6T networking platforms.
Which is huge, because in a data center, you can have all the advanced GPUs in the world, but if they can't transfer data between each other fast enough, they just sit idle.
Right, it's a massive bottleneck.
So winning the manufacturing contracts for 1.6 terabit network platforms, the switches and optical transceivers that solve that speed bottleneck, is a monumental victory.
It is, and it also systematically reduces their reliance on any single customer, because every major data center needs that exact 1.6T networking infrastructure to function.
Yeah, it becomes a universal need.
Furthermore, they are firmly positioned as a preferred partner for Google, precisely as Google announced they are doubling their capital expenditures for 2026.
Doubling their capex. That's wild. And then you have the massive AMD partnership on the Helios project.
The Helios project is a paradigm shift for their manufacturing scale. They are not just fabricating individual circuit boards or components anymore. They are building rack-scale AI platforms.
Right. So this means assembling, testing, and delivering entire integrated server racks purpose-built for massive AI workloads.
Exactly. The logistical complexity and the revenue generated per unit on a full rack-scale system are exponentially higher. That is the exact mechanism driving their $17 billion revenue guidance.
But here's where it gets really interesting, though, because as much as I appreciate the mechanics of 1.6T networking and rack-scale integration, I have to push back.
Okay, let's hear it.
We have seen this exact setup in the tech hardware sector before. Aren't retail traders the exact demographic that gets trapped holding the bag when a manufacturer relies so heavily on the capital expenditure whims of a few massive tech giants?
That's a very valid concern.
Because if Google decides to delay a data center build-out by 6 months, or AMD shifts a production line, Celestica absorbs the shockwave.
That structural vulnerability is the absolute bedrock of the bear case. And it is crucial we analyze this objectively, which, as a reminder, this discussion is purely an analysis of the available data and a natural debate about market mechanics. It is absolutely not financial advice.
No, never financial advice. You always have to do your own research.
But your point regarding customer concentration is the exact risk the bears are highlighting. Despite the new networking wins, Celestica still derives a dangerous percentage of its revenue from a handful of hyperscalers. If one of those giants sneezes, Celestica catches a severe cold. More importantly, the bears point to the mechanics of their legacy business. While the AI infrastructure segment is exploding, their advanced technology solutions segment, the ATS division, actually suffered a 4% revenue decline.
Oh, wow. So the legacy manufacturing business is quietly shrinking in the background, but the sheer velocity of the AI data center boom is masking that underlying weakness.
Exactly. When you fuse that structural segment weakness with the immediate technical warnings like a stochastics reading over 90 and relentless executive selling backed, the bears argue that the worst-case scenario isn't just a brief, healthy pullback.
What do they think it is?
They argue it's a structural continuation lower once the AI hype cycle normalizes. Retail traders frequently get trapped in these exact setups. They buy the vertical momentum at the absolute peak, right, as the institutional algorithms and the corporate executives begin offloading their positions to lock in profits. And the sheer volatility of that transition is usually enough to shake out the average investor.
So what does this all mean for the immediate future? Because we don't have to wait in suspense for months to see whether the pipe bursts or the short sellers get squeezed. There is a massive catalyst sitting right in front of us.
Yes, there is.
The first quarter 2026 financial results are slated for release on April 27th, 2026.
That date is the crucible. In the short term, over these next few weeks, you can expect violent volatility leading into that earnings call. The technical indicators suggest the broader market is actively pricing in a beat and raise scenario.
Meaning they expect Celestica to not only beat the Q1 estimates, but to aggressively raise their guidance yet again.
Exactly.
But with earnings dropping on April 27th and the stochastics indicator warning us that the momentum is totally exhausted, are we staring down the barrel of a classic buy the rumor, sell the news event?
It's highly possible.
Because even if they report spectacular numbers and raise guidance, the stock could still plummet simply because everyone who bought the run-up decides to liquidate their positions at the exact same time to secure their gains.
That is the precise short-term mechanical risk. However, if you step back from the quarterly earnings volatility, you have to weigh those technical signals against the undeniable physical reality of Celestica's long-term operations.
Right, the concrete being poured.
Exactly. They are not just projecting abstract software growth, they are literally pouring concrete. They have initiated a massive $1 billion capital expenditure ramp to aggressively expand their physical manufacturing footprint in Texas and Thailand.
$1 billion. You don't authorize $1 billion in physical factory construction unless you have ironclad, multi-year contracts locked in to justify that capacity.
You really don't. And that physical expansion is inextricably linked to the AMD Helios rack scale collaboration. You can manipulate software engagement metrics or adjust digital projections, but you cannot fake the physical logistics of $1 billion factory build-out.
No, you can't.
To the bulls, That expanding footprint proves that the $17 billion revenue guidance isn't just a hopeful projection. It is a logistical certainty demanded by the physics of the global AI supply chain.
Which perfectly encapsulates the incredible tension woven through our source material today. On one side of the ledger, you have record-shattering revenue projections, billion-dollar physical expansions into Texas and Thailand, and a top-tier analysts at Goldman Sachs and Bank of America issuing price targets north of $400.
Yeah.
You are basically looking at the ultimate foundational picks and shovels play for the global AI gold rush.
And on the exact same day, on the other side of the ledger, you are looking at a technical chart that is stretched to the absolute breaking point.
Right.
You have an overpressurized momentum gauge flashing a stark sell signal, nearly 20% of the available shares sold short, and the very executives who designed this growth actively offloading tens of millions of dollars of their own stock while placing zero buy orders.
It's a wild contrast. You are either buying into the fundamental physical architecture of the future at a rare forward multiple discount, or you are buying the absolute peak of a momentum trap right before the structural floor caves in.
Which leaves us with one final critical question to ponder.
Let's hear it.
If Celestica is genuinely the preferred physical builder for Google and AMD's AI infrastructure, literally manufacturing the next decade of technology, is the recent multi-million-dollar insider selling just a routine administrative distraction, or is it the ultimate canary in the coal mine for the entire AI hardware sector?
That is the multi-billion-dollar question. And remember, absolutely nothing we have discussed today is financial advice. We are simply examining the blueprints of that massive new mansion and trying to figure out if the foundation can support the weight or if those departing architects know something we don't. We highly encourage you to keep exploring the markets, dig into the underlying data yourself, and form your own conclusions. Thank you so much for joining us on this deep dive. We'll see you next time.